Hello, everybody, and welcome to the next EverGuide Financial webinar. Today, we're going to talk about the stock market and whether or not the bottom since October was a start of a new bull market or if it was a bear market rally. So, first, before we get into that, I want to talk about our last webinar, which was towards the end of the summer last year. And it was talked about the post-pandemic downturn recap. And some of the things that we talked about, one was that the 60-40 portfolio, 60% stocks, 40% bonds, saw its worst year ever. And that was mainly driven by bonds. Next, what we saw last year was people were saying that they were scared of stocks, which there's the AAII bullish and bearish sentiment had a lot of bearish sentiment, very little bullish sentiment last year, but that didn't really match with what the flows were happening. In fact, the flows into stock funds continued pretty much unabated last year, while there was quite a few large outflows from bond funds. Additionally, in that webinar, we expected to see a peak in inflation towards the end of 2022, which looks like it ended up happening. And we also highlighted that even though if you look at the bond market, the 2-year, 10-year inversion says that a recession should come at some point, but in order to look and see when that would come, you really have to highlight looking at the 2-year Treasury versus then Fed funds rate and how that would really show when a recession would be imminent. And because of this and the uncertainty and where valuations where we talked about using active management to really sell rallies and buy dips, and that is really that has really proven to be fairly interesting over the last, we'll call it 6 or 7 months, as the market has stayed fairly range bound within we'll call it a 10 to 15% range between the upside and the downside. So today we're going to talk about, is this a bear market rally or a new bull market? As I just said, markets overall have been pretty range bound for almost a year now. Some are claiming that the October low kicked off a new bull market. Others are saying that this is still a bear market rally that's just taking a little bit longer. And when you look at it, the bull market is really technical, and the bear market rally is really more fundamental. And one of these will eventually prevail. And we're going to walk through some of those things that you're hearing in these arguments from both bulls and bears right now, and see which ones have more credence. So first off, we're going to start on the fundamental side. And this has really been the focus of the last several years. Really dates all the way back to 2009 when the Fed started implementing their zero interest rate policy. With 0% interest rates, it's always, well, where else can we go? And that was part of the reason that we saw the bubble of 2020, 2021. Now, one of the things that's interesting is, so if you look at this chart, the blue line is the 2-year Treasury and the white line is the Fed funds rate. So as you can see, by middle of 2021, the 2-year Treasury really started to move up there. And the Federal Reserve was several months behind, and they had to start hiking in a very, very aggressive way to catch up to the 2-year. And then, right towards the end of the year, they started to come in line. Then the 2-year spiked higher and then fell dramatically after the somewhat of a banking crisis. And the Fed funds and 2-year has had a disconnect. Now, why is this important? Because, and why is it something to look at? Because the 2-year Treasury is really the market's way of saying whether or not the Fed is too tight or it's too loose. So right now, most people are expecting one more hike and then pause. So you can expect that this another 25 basis points, you're going to be well over 5% here for the Fed funds rate. So unless the 2-year rate catches up, and the longer that it stays below the Fed funds rate, I think the idea of recession or the fact that the Fed is going to have to start cutting rates is going to become more mainstream in that view. So why is this important? Because when you're talking about cutting interest rates or raising interest rates, because it really has to do with its inflation and its recession. And a recession is important because it really it's tough to say whether it's going to be mild or if it's going to be strong, but it's something that can really drive asset returns. So I want to take a look at the possibility of recession. This is the composite of leading indicators. So when this year over year change, so this is the zero line, as you can see, the gray shaded areas are recessions. And in fact, every time that we've come down to this level, we have seen a recession. In fact, even if you get below zero, there's been a couple times in the 90s, one time, 2016, where we just went slightly below. Even if you go to 2020, we went slightly below, started to come back, and then obviously dropped off pretty dramatically in the pandemic. But anytime we've come below zero, every single time since the 1970s, we've experienced a recession. Every single time. And we're now sitting here at this point, and there's still a discussion on whether or not we'll have a recession or not. Maybe this is the one time that we will not have a recession, but it is pointing towards that. Additionally, what was interesting to me in particular was during the last Federal Reserve minutes, there was discussion about expectations for a mild recession in the second half of 2023 from the Federal Reserve. Now, I've never, and a lot of people that have followed the Federal Reserve for much longer than I have never heard the Federal Reserve actually admit that they're expecting a recession. And that's something that's fairly new. And the interesting thing about it is, so this is the New York Federal Reserve recession probability in the next 12 months. You can see where we are here. This is higher than where we were in 2020, where we were in 2009, where we were in 2000. In fact, it's probably the highest we've been since the early 1980s. And if you look back again, anytime we've been over this level, every single time, even if you go to 0.4%, there was one false signal here in the 1960s. I guess you can consider this a false signal in late 1990s. But every time we've been above this level, recession, 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 recession. So it's fairly consistent with recession. Again, that's probably why they said they're expecting a mild one in the second half of this year. Now, what's interesting is as we come into this year, and some people are surprised at how well stocks have been performing in the face of all of this recession talk. One of the things that's interesting is that some people are saying, well, stocks are already priced it in. Stocks have already priced in the probability of a mild recession. And so because we had the fairly large downturn, of 20% in 2022. And so the idea then is, well, now we need to get in front of it, because for the last 15, 16 years, we've had 0% interest rates, and that drove asset price higher. So if we get a recession, then the Federal Reserve is going to have to cut interest rates again, and that means that stocks are going to go higher. The interesting thing about it is, if you go back all the way to 1929, if we haven't had a recession yet and we're still expecting one, I don't see that we can actually have priced in the recession in stocks, because every single time since 1929 that we've had a recession, the stocks have not bottomed until after it started. So 34 months, 10, some of them are shorter, 1 or 2 months here and there. But on average, it takes several months after a recession for stocks to bottom. So again, this idea of already pricing in a recession, I think that's really grasping at straws. One of the other things is, we talked about some of the probability of recession. But there's one thing where there's still a group of people that are saying, maybe we do not see a recession because the economy is just that strong right now coming out of the pandemic, that all of these things that we've looked at in the past are really don't matter because of how strong the economy is. Now, this chart here is actually one of the things that really stands out based on that, and that's the idea that, well, the job market is so strong, it's going to be difficult to have a recession with such a strong job market. And here's one of the things that's confusing a lot of people. So this chart goes all the way back to the 1950s. The darker green line is the deviation in the unemployment rate from the cycle low. So you can see recession, unemployment rate spikes, recession, unemployment rate spikes. The lighter green line is deviation of job openings. So how many jobs are available? So this makes sense. Job openings drop, unemployment rate spikes. Job openings drop, unemployment rate spikes. And again, in the 1960s, there was a couple of times where job rates started to drop. Unemployment rate went up a little bit, but didn't really do too much. But every time we've had a spike in unemployment, we've had a recession. That makes sense. What's interesting is if you look at these drops in job openings, every single time we have a drop in job openings, unemployment rate spikes. Every single time, going back to the 1950s. What's interesting is right now we're at a point where we have this large drop in job openings from the cycle high, and there is no spike whatsoever in the unemployment. Take that as you will. Maybe this is the only time that we are not going to see a spike on unemployment. Maybe we just haven't seen the spike in unemployment happen yet. But every time we've been at this level, jobs have spiked and we've seen a recession. So again, maybe this is one particular outlier, but the odds are, and history has said, when you have jobs start to lose, the next thing you go is unemployment rate. So again, why are we talking about all of this stuff about recession and the importance of that? Is because when you look at the Federal Reserve and interest rates, whether we have a recession or not is going to be have huge implications on what happens going forward. So if you look at what happens, so this chart here is indicative of what happens with a bear market and interest rate cuts with a recession. So if you look at the yield curve, and I didn't bring that up in this webinar, but yield curve steepens, credit tightens, first Fed rate cut. Here's the S&P 500 returns. So not too far off the highs when you get your first rate cut. And then you have a dramatic drop in a very short period of time of S&P 500 returns. And then it eventually troughs, EPS comes back, you get across, and then we start to move back to new highs. And this goes all the way back to 1871. Now, what's interesting is, and why I want to bring this up, is if the Fed is cutting interest rates and we do not have a recession, yes, you can see markets move to new highs. You don't have to go back that too far to think about this. That was 2018. 2018, if you remember, in October to December, markets were down about 20-some%. The Federal Reserve was trying to tighten. They paused. They actually started to cut rates. We did not have a recession in 2019, and we had a very, very good year, basically going into 2020 in the pandemic. At the same time, when the Fed cuts interest rates and you have a recession, that is not the beginning of the end. That is really the beginning of the beginning of the bear market. So even though markets are off their highs going into that rate cut, the real downside starts to happen afterwards. And that's when the reality of how poor earnings are going to be really starts to set in. And that's why I think this is really important, because one of the bullish thesis, at least on the fundamental side, is, well, if inflation starts to slow, the Fed's going to stop and they're actually going to start cutting interest rates, which means that you can start buying these long duration assets. And so it's interesting because it kind of, we're coming off an inflationary environment where we're trying to cut inflation. I just don't see the logic in why would the Federal Reserve, maybe they'll pause interest rates, but why would they start cutting interest rates if the economy is still going to be fine? I just don't see it. If I'm the Federal Reserve, I think most of them would be of the mindset, we're not going to cut interest rates unless something really, really bad happens. So it's one of those things where you be careful what you wish for, because the reality is, unless they're cutting interest rates and no recession, the ability for the market to take this type of dive is still sitting in front of us. Does it come to fruition? We still need to figure that out, but the risk that is still obviously there. Another thing, and we're going to start to get into the technical side and move away from the fundamentals, because I think we've talked enough about the risk of recession and interest rates. But now we're going to get more on the technical side. And one of the things that you're hearing a lot of is, well, there's a lot of cash on the sidelines. That there's cash on the sidelines, that's more dry powder to get put to work into the stock market. What's interesting, though, is, and we have seen an uptick, especially over the last 6 months, in money being moved into money market funds, into cash. And that makes sense because we've had 0% interest rates for the last 15 years. Now, all of a sudden, you're getting 4% in the money market, and that looks much more attractive. And that makes sense, too, here, if you look at this chart. So this is money market deposits as a percent of total equity and bond market. So what's interesting isn't that, because the market has grown over time, you can't look at something on a standalone basis. So if you look here, we had increased going into 2003 bear market bottom. We increased going into the 2008 bear market bottom. We increased going into the 2020 pandemic bottom. And here we are right here at levels really not seen since, the mid 1990s. So this is not elevated whatsoever as a percentage of total equity and bond market value. And it really comes along with, what I'm seeing personally with prospects and other people I'm talking to in the business. There's really not much fear, and people aren't, trying to put their cash under a mattress, which is something that we've seen at major bear market lows in the past. And I think you can kind of throw these numbers out because, again, like I said, these were 0% interest rates, all in here. Now we have some interest rates, and cash actually has some type of risk. Another argument that you're hearing a lot, which is technical, is the fact that investors are positioned negatively. That actually makes a lot of sense. If you're negatively positioned, you're surprised to the upside, and you have to put that money back to work, and that moves stock prices higher. So what we have here is a chart of, blue is the S&P 500, and yellow is hedge funds and their position. So the higher the positioning, the more exposed they are to the market. The lower positioning, the more negatively they are positioned. So as you can see here, the hedge funds are the most negatively positioned that we've been since the 2008 bear market. Interestingly enough, if you take, just on this level where we were, and hedge funds were positioned negatively, that just so happened to coincide with the peak in the market, not the trough in the market back in 2007. In fact, there was a lot more downside. And what's interesting is the hedge funds actually became the most bullish on the market near the lows. So this idea that hedge funds have to move and change where they are didn't really hold any water in the last bear market in 2008. What's interesting, though, is if you look at the bull market from 2009 to the end of 2021, every time hedge funds got bearish, that did coincide with a bottom. It got bearish, it coincided with a bottom. They got bearish, it coincided with the bottom. They got bearish, it coincided with the bottom. And so, so the interesting thing about it is, yes, in a bull market, this is a great contrarian indicator. However, in a bear market, it's not necessarily a contrarian indicator. So this on a standalone basis, I don't think necessarily means one way or the other, because we're not really sure how much that position is. Maybe they're positioned because things are about to get really bad. And so at some point, yes, that will lead fuel to a rally, but as a timing tool, I don't think it necessarily makes too much of a difference at this point in time. One of the other things, and again, we're going to continue to focus on the technical side of things, is this thing called the Zweig thrust. It's a Brett thrust. And what this is, without getting too much into it, is basically looking at a large amount of buying across many different stocks in a short period of time. And so this goes over the last 23 years and looks at any time we've seen those indicators. So it happened here before markets at the bottom. It happened here at the bottom, here at the bottom, here they continued higher. This was 2018, continued higher, and now we just saw one again at the end of March. And so I've seen this quite a bit recently, where, oh, okay, well, the market is saying basically the worst is over, because now more stocks are participating. And it's funny because this did signal at the end of March, but at the same time, the majority of the returns have been in fewer and fewer stocks this year. So it's something to look at. It's also only happened. This is the seventh time it's happened. Yes, it could mean something, or it could be something, or it could be something else entirely. Next, we want to take a look at deleveraging. It's one of the things that we talked about last time, and how the deleveraging process had to come into place. Um, and we've actually seen a lot of deleveraging already. In fact, what this chart looks at is the margin balances on brokerage accounts. It's something that's reported to FINRA on a monthly basis. So the idea is as people start to buy more and more, and they're more interested in the market, they're willing to borrow against their portfolio and buy more stocks. And actually, as margin balances go up, markets go up. As they go down, markets go down, and you can see a bottoming here was the bottom of the bear market in 2003. The bottom here was the bottom of the bear market in 2009. The bottom here was 2016 after that small correction. Here was the bottom in 2020. And in fact, we have a lot of deleveraging took place in 2022, and it looks like it's starting to bottom again. Now, I will caveat this as well and say, well, you have to kind of look at the trend, because this was 2018. The use of margin bottom, it did move higher for a period of time, and then they really fell off again going into the second bottom in 2020. How this moves going forward, I think, will be a big indicator of where the market moves. So if you see it really start to move higher going forward, I think that's going to be a very good indicator that this maybe is a new bull market and things can move forward and the worst is behind us. If it does kind of hangs around here and doesn't start to move up pretty dramatically, I think that means that we're at risk of some more deleveraging happening at some point in the future. And what do I mean? Just to go back, what do I mean by deleveraging? Well, if you're borrowing against your portfolio to buy more shares, if those shares go against you, then you're going to be forced to sell them all at once. And that's when you can see crashes in the market, where the market drops 5-10% in a short period of time, because you're being forced to sell even if you don't want to, because you borrowed against your portfolio. So another thing that I've heard a lot recently is, has the rally lasted too long? The idea is that bear market rallies are very, very short, and that they are short and violent, but then you roll over to new lows relatively quickly. Now, this actually goes back to 1950 and looks at the gray shaded areas of the recessions. The green is how long these bear market rallies lasted in trading days. And so previous to the 2000 bear market, they were short. Longest one, 10, 26, 55, 49, 71 days. So they were fairly short. Now, what's interesting is in the 2000 to 2003 bear market, we had one which was over 100 days, and then we had another one that was 194 days. And in 2009, we had a 61 day. This was obviously very short in 2020. We've had a long one that was, a little over 61 days earlier last year. And now we're sitting at around 128 days as of today. And really, what I come down to is, I don't know that this necessarily means anything, because if you go back to 2000, 2003, this bear market rally of 194 days, or even this one of 100 days, we had never seen that before. I'm sure many people at that point in time were saying, "Oh, well, this rally has lasted too long. We can't continue to see a bear market. This is a new bull market." And I just don't think that how long the rally lasts really matters. I think it's going to be a bunch of other indicators. And, maybe this lasts 128 days. Maybe it lasts 150. Maybe it lasts over 200 days. I just don't think it really is going to matter on how long the rally is, as whether or not we're in a new bull market or if we're in a continued bear market. So lastly, I did want to talk. So we talked about some of the technicals that are facing more bullish. We talked about the possibility of recession, which would be more bearish. But what the idea of a bear market is that you reset valuations. You get rid of the excess and you reset valuations. The interesting thing about it is we were so extended on the valuation front in 2020 and 2021 that even with a very, very poor year in 2022, all we really did, and this is just looking at valuations relative to GDP, and all we really did was reset. And you can see that the difference of blue and the green line, and it's just a small difference because it's adding total assets of the Fed. They stayed relatively similar, and now when in the era of QE, that's why the green and the blue line are separated, are much more different because again, quantitative easing, the balance sheet of the Fed has grown pretty dramatically. That's why you have a difference. But if you look to what we did in 2022, all we really did was reset back to peak.com levels. We didn't get back into down to where we had seen in the past, where I would sit there and say, okay, well, valuations are very, very cheap. A lot of negativity has been put in. I think this should be okay. All we've done is gotten rid of some of that excess and we've reset. So it remains to be seen on what happens with valuations going forward. But you have to remember, again, from this period to this period, so this entire from 50% to 200%, we had 0% interest rates. Now you got 4.5% interest rates on cash. And so if the argument from 2009 to 2021 was there is no alternative, that's why valuations are so high. Now we're at a point where there is an alternative. So why are valuations still this high? It's just something to consider. So we'll go to course of action. What do we think going forward? Basically, fundamentals are finally saying a recession is imminent when you look at a bunch of the different indicators, but in particular, the 2-year Treasury versus the Fed funds rate is finally below. Even though positioning is somewhat negative in stocks, stocks are still priced currently as if there will be no recession. We do think you need to hold some long-term treasuries in case a deep recession manifests. And this is based around the idea that while the Fed is predicting recession, the indicators are predicting a recession. The stock market is saying there is not going to be a recession. So whether it's mild, if it's short-lived, I don't think anybody really knows because we've been at 0 interest rates for 15 years. We've never been that way. And then we went from 0% to 5% in less than a year. The effects of this, we haven't even begun to see it. And I have no idea. Global economists have no idea. People at the Federal Reserve have no idea what the effect of this is going to be. Maybe there is no negative effect. But the reality is nobody really knows. And so you have to kind of guard against the potential for a deep recession by owning those long-term treasuries. And at the same time, upside in stocks should be limited because valuations never got low enough. So when you look at it, yes, there's the possibility that we can continue to trade sideways and grind higher. But we like to look at it as a risk reward scenario. The reward for upside being fully invested in stocks right now is maybe 5 to 10% potential upside, given those valuations. Unless, there is a possibility that even with inflation not fully down, the Federal Reserve decides to cut interest rates without a recession. And then maybe you could see that 200% again, and maybe it moves up 30, 40%. That is obviously a possibility. I just think it's a very, very low possibility. So back to the risk reward, I think the risk or the reward is maybe 5 to 10% upside because valuations are still very, very high. And then the downside could be fairly large if we do see even just a run-of-the-mill recession. You could potentially see 20 to 40% downside in stocks. And that's why I think you need to still be in a balanced approach. So that's where we are right now. If you have any questions, feel free to send me an email. We can go into more in depth and look at some of the other things that we're looking at. Thank you very much.